Hello everyone, and thank you for joining us. Today we're going to be discussing the True Potential Portfolio Solution, and in particular the key themes that have come out from our discussions with our portfolio manager partners over the month of May. I'm joined by George Bell today, who will bring that to life from the perspective of the True Potential Portfolio Solution. I think it'd be fair to say that a number of the themes that we've been discussing as an investment team with our partners and discussing on morning markets, etc., have continued to run through the month in terms of inflation, interest rates. But maybe there's been some subtle changes as to how that's been communicated and some changes that we've seen through May. And George, I don't know if you want to bring some of that to life now.
Yeah, absolutely. I think that's a key thing. What we've really seen is an evolution of these themes and some of the data points to help inform, our outlook and what we can expect to see as we move forward. And just to bring some of those to life, if we look at the growth side of things, we've seen the economic growth prints from the US, from the UK, and from Europe. In the US, you had a softer print. You had a contraction in that first quarter of negative 1.5%, but just for context, that was coming off a strong reading in the final quarter of Q4.
And a large part of that US number is the terms of trade and the changes there. So the domestic economy was still relatively robust.
Exactly, yeah. In the UK, in Europe, we had some slightly softer prints, but still positive. So 0.8 in the UK and 0.3 in Europe. But I think, what it's really bringing to the fore is the reality of some of the challenges which we've been discussing around tighter supply chains as a result of the war in Europe, as a result of tight restrictive activity within China. It's bringing to life the fact that we are seeing a squeeze on living costs and the fact that financial conditions are starting to tighten in line with central banks raising interest rates to really manage the next component. And a lot of these factors do feed into one another, being inflation, where again we've seen some updated prints around inflation. And really what we're seeing in the US is, quite interestingly, we're seeing some softening in the prints month on month. So in terms of CPI, so the headline style reading, we saw a moderation in that first print which came out in May. We also saw a moderation in the PCE measure as well, which is...
And that personal consumption measure is the one that all commentators and we as well believe that's what the Fed really focuses in on, as opposed to CPI, which I think declined from, was it 8.5 to 8.3 over the month?
Yeah. It's interesting, the PCE reading, in terms of what it's essentially doing and how it differs from the CPI. It's a little bit more adaptive in terms of the way in which it recognises consumer spending habits will adjust as prices do start to rise. So the Fed tend to prefer that sort of metric. But in terms of what it's shown is a softening month on month, whilst what we're seeing in the UK and in Europe is inflation still rising, so prints which are moving higher.
And that was probably very evident in Europe today, or yesterday I should say, when we saw the reading for May at 8.7%.
Exactly, yeah. And I think it's really bringing to life some of the challenges around the energy side of things. So for example, what you've got in the US is an economy which is more independent in terms of its energy production and therefore consumption. The UK and Europe are much more victims of importing inflation through higher energy prices because of their reliance on overseas sources there.
And then if we think about that backdrop and how your growth is evolving, policies evolving, and the inflation dynamics are coming together, clearly that presents opportunities and challenges for our managers, and they've been making a number of changes or evolving some of those things that we discussed last month in terms of the positions of the portfolios, or the underlying funds, I should say.
Yeah, absolutely. I think some of the key changes which we're starting to see, given the challenges in that backdrop, we've seen a moderation in their total exposure towards equities. So risk assets there. We've also seen a rotation within the type of equities which they're holding, which I think is quite important here. What we've seen is a rotation from the equities which are a lot more sensitive to what's happening in terms of the health of the economy. And they've been rotating towards the type of assets which are more defensive in terms of their characteristics. So an example from a more defensive sector style could be healthcare type companies, but also it could be companies which in general are less volatile than their relative index. So it's bringing about a construction in the portfolios which is slightly lower risk, but in terms of the makeup.
And some of those aspects that you mentioned there are core parts of the building blocks for one of our managers in particular, but others starting to use those as well.
Exactly, and we've emphasised that in one of the trades which
Mhm.
we've put through in terms of our portfolios within our Cautious Plus model as well. But I think it's also just in terms of what have our managers really been doing, and where do they see the opportunities. The other theme which has evolved over the month has been central banks and their response to that challenge of
Yeah.
rising inflation. And we saw the Fed, which raised 50 basis points, taking us to the 1% level in the US in terms of interest rates. And then this week we'll kick off quantitative tightening for words of that effect. In the UK, we saw a 25 basis point hike taking us to 1%, and we're waiting for liftoff in Europe with the ECB, but we're expecting that to come.
It's certainly been well telegraphed that we're going to get a change from the ECB in the coming months.
Exactly. Yeah, there's certainly been a shift in terms of the dialect which has been coming out of the ECB.
And I just wanted to come back to something you said there about how our managers are changing the equity allocation. It's also at some managers how they access it. So if we think about the changes that a number have been making from market cap weighted to equally weighted exposure, which has really brought a difference to portfolios, how portfolios behave. But our clients will just see their US allocation maybe unchanged.
Yeah.
But there's been a real sea change below that index level as to how it's been accessed.
That's a great example. That's one of the examples which are in-house fund range growth aligned. They've been implementing, and essentially what you're doing there is you're reducing your concentration which you have on the big large cap companies which dominate in the US and have been more sensitive to this environment, which has been higher yields. So higher yields have an impact from the cost of financing, but also in terms of how analysts value that company. Essentially, what they're looking at, the value of a company, many different ways to assess this, but one way is to look at the present value of cash flows as we look forward.
And we've seen that really come through this month in particular, or even the year to date, really, is how growth has performed in the US relative to value, for example.
Yeah, so we've seen that real differential, and I think again that talks to the preference which we've had, which Chris will have alluded to last time, but it's that preference in terms of equity style towards more defensive, but also that value tilt in terms of that exposure which we've had.
And one of the other things that was coming out of the discussions plays into that ongoing change that we've had within the portfolios of the role of alternatives.
Yeah.
And certainly they have been working for our managers, but there's a subtle change in how that was being discussed over the month as well.
Yeah, exactly right. I think alternatives, why have they been really useful for us within the portfolios? It's because we've been in a rising interest rate environment, and we've been in an environment with a backdrop of rising inflation and commodity prices overall. So it's been a challenging environment for your traditional government sovereign bonds. Yields moving higher is negative for the price there. So what can we offer? We are a multi-asset investor. So one of our allocations which we have exposure to is alternatives. The role there is generally to offer you a very different experience to what you would have in sovereign bonds, or in terms of context, a low or negative correlation. And that's exactly what they've delivered. They've delivered this by having the ability to go long certain asset classes, short certain asset classes, or even within sectors. So what's been working for us year to date is having exposure to alternative assets, which are long commodities, short equities, short fixed income, or matching the currency pairs of those commodity exporters.
And that's typically been funded from sovereign credit, where our managers haven't wanted to have a lot of longer duration exposure or timeline of exposure.
Yeah.
But maybe this month there was a slight change, just given how sovereign bonds have performed, how yields have started to maybe reflect a more realistic scenario.
Yeah.
And some interest there coming
through. And I
through.
think that's, we talk about multi-asset investing always providing opportunities. That's where we are seeing the next leg of opportunity. So alternatives have done the job for us in the respective, offered us that diversification when sovereign bonds, as we saw yields moving higher. But now we're seeing yields at a level where our managers are seeing, from a government side, more digestible in terms of the yield on offer, and on the corporate side, so holding company bonds as well, a level of yield which is compensating well for the risks which they see. So they see a valuation case and a return.
And that's certainly something that, through the work that we do, seeing how the portfolio managers are evolving, we'll be able to come back in sort of discuss that more, I think, probably next month.
Exactly. So we dig into our managers every time we have contact with them,
Yeah.
at least once a month. But realistically, Chris, myself, and the team are in regular contact with our managers, and we tend to hook on if they give us a glimpse as to what
Yeah.
what's on their research agendas. We'll hold them to that. We'll really challenge that view and see how that builds
And
out.
thinking about that over the course of the month, clearly there's been change, evolution, as you point out, at the manager level, at the fund level, and that's hasn't led to any changes within the core portfolio allocations this month, but has led to changes within both our plus portfolios and the income portfolios. I wonder, is it worth maybe starting just in the income portfolios and some of the changes or the ongoing change probably that we've made there?
Yeah, absolutely. Just to bring to life, when we are reviewing our portfolio allocation, this is an ongoing process. Our managers are also active, and they're making changes on an ongoing basis. So month to month, you wouldn't expect a full portfolio rotation.
Yeah.
So these are evolutions, but the key evolutions which we've been making within the income suite have really been the introduction of our new fund manager partners being UBS, so an existing partner, but with a bespoke solution for true potential on the income side, but also Waverton as well, who've joined our
And we've
income
had
range.
very clear objectives as to what we wanted to achieve there in terms of enhancing income, but also bringing more diversification to the strategies.
Exactly that. So diversifying in the asset mix which
Yeah.
income investors have available in a way which is supportive of the yield and the expected return, and that's exactly what we've been able to achieve.
And maybe bring that to life in terms of where the yield was to where the expected yield is today.
Yeah,
as a
absolutely.
result.
So we were, if we go back to the beginning of this process, which was in February, we had a net yield forward looking on the cautious income portfolio of just under 3%.
Yeah.
We're now at a level of 3.35%. Yeah. We're at a level of 3.5% in terms of the balanced income portfolio. So we've done that by diversifying the asset mix, but also giving us exposure to managers which can offer us a stronger yield, with the example there being UBS and the way in which they
And then
work.
if we turn that to the plus portfolios, really the changes that were made there are for different reasons and very much reflect that evolving backdrop that we've discussed in terms of a degree of caution and more taking some risk out of portfolios is what we would probably observe that to have been.
Yeah, correct. So in terms of the cautious plus portfolio, the key change which we made was exactly as you say, was around the risk. So what we've done is we've taken from one of our higher risk funds and we've allocated to lower risk funds. So within doing that, we've taken out 7IM's growth fund and we've allocated the proceeds to the to the growth aligned and to the SEI defensive strategies. Essentially, those strategies are key players in that theme which we highlighted earlier on, being the move towards more defensive equity exposures as well. So we're bringing about defensiveness within that portfolio in terms of the total risk exposure, equities, higher yielding bonds, but we're also doing it in terms of the mix of equities which we're holding with those managers as well.
And then in terms of sort of bringing that all together, the backdrop's evolving, what our managers are doing continues to evolve as well and adapt to that changing market environment, identifying opportunities and taking those in the portfolio. Just in terms of the outlook, could you maybe sort of sum up what we were hearing from the managers over the course of the calls that we had?
Yeah, absolutely. I'll try and keep
a difficult task, I know, because there's a lot of views out there.
I'll try and keep it brief, but in terms of economic growth, we're seeing softer prints coming through now, but we are expecting economic growth to remain relatively healthy as we look into 2023 and 2024. So current expectations are for prints to be just over 3% on a global basis, which is a strong level. So in the US, we're not expecting a recession this year, but we recognise that given the impact on living costs and so on, that risk is slightly higher in the UK and potentially in Europe. But globally, as we look to the years ahead, economic growth to remain robust. In terms of inflation, we are anticipating to see the peak this year. I think the earlier signs are there in the US, where we may see a peak anytime now. One data print doesn't make a trend, but our readings, which give us a more granular view of how the factors are evolving, give us a sense that we could see the peak.
And
in the
certainly
US.
that seems to be a very important factor for the market and market participants to get comfort with.
Yeah, and hence within bond markets, it feels like we've really worked our way through the tightening cycle. But actually, we're at the very early stages. If we think about central banks and where they are, the UK, the US, and Europe are actually yet to sort of really kickstart the cycle off. But bond markets have really reacted to fully pricing.
Maybe just one other point to bring out there is just that difference with China in terms of where they are, and over the past couple of days we've got more information about how lockdown in Shanghai is being eased. Within China, a number of factors going on. You've got growth targets, which they set out very clearly, 5.5% per annum is the target. They're falling behind that. They're falling behind that because they've got a number of constraints. One is activity restrictions. So a zero COVID policy, which essentially tightens domestic travel, the ability for factories and business to open, in schools, and for production to meet its full capacity. With that squeezed, it has an impact on growth. We're feeling that outside of China as well in terms of supply chains, but it's impacting growth. We've also seen a response from the central banks in order to try and stimulate demand by reducing mortgage costs, essentially, or the rates associated with mortgage costs. So I suppose that's the real contrast, isn't it? Policy tightening in the largest economy in the world, in the US, but second largest policy loosening, and certainly sets up a very interesting backdrop for the rest of the year for us to navigate and for our managers to navigate with the portfolios.
It's put a huge amount of pressure on governments in order to react. We've seen the response from central banks in China, but what are governments going to do? And that's why over the last few days and weeks we've started to see some easing of restrictions within Beijing and Shanghai, which should be supportive for supporting the overall growth picture in that viewpoint of inflation starting to moderate as supply chains open up.
Okay. No, that's been really useful, George, and thank you for bringing to life what's been happening within the True Potential Portfolio Solution. Hopefully for you, our clients, you found that useful and also interesting. Please do give us feedback if it's not covering all of the points that you want. It's very difficult to pull everything together in such a short video, but do let us know what you would like to see in the videos going forward.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.